At Gem Young.
It's time now for the Gem Young Wealthcast. Brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprilli.
Welcome to the Gem Young Wealthcast. This is Leo Daprilli. In our continuing quarterly analyst analysis of what's going on in the market, I have another one of my favorites today. I have Glenn Dorsey. He's the Senior Vice President and Head of Client Portfolio Management at Clark Capital Management Group. Glenn always gives a lot of great insight, and we're going to take you down a couple of different roads than we normally do. We normally dig right into what's going on in the market in the past quarter, but there's been a bunch. So I thought we would start with Glenn, and let's talk mechanically how Clark Capital's been managing these changes and challenges in the market. And the reason I wanted to do this, last time Glenn and I spoke, he made the comment that the markets were kind of priced to perfection. And everybody sort of agreed with that. So we want to see that with that point of view from a money manager's perspective, when you see things priced at perfection, what do you do from an analyst point of view, portfolio management point of view, from a sector point of view? So I really want to get into the weeds today with Glenn to do this because it's been a different quarter, and I think it will give you some great insight to what really happens when things aren't always hunky-dory like they were earlier in the year, when no matter what you did, we all look smart, okay? Now it's a bit of a challenge. The tech sector, which was very hot, purely priced, going through market corrections, you hear me joke all the time that sometimes it's like being at a party. 3 months ago, it was 11 o'clock at the party and everybody's having fun. It's a great time. Now it kind of feels like 2 a.m. Most of the people are gone, right? And you're starting to realize what's left, and reality starts to set into what's really going on. So that's what we're going to dig into today and give you some more insight on that. So, hey, Glenn, how are you today?
I'm well, Leo. Good morning.
Yeah, so it's been nice to have finally getting all of our audio and video corrected, so that we weren't kind of doing things in a crazy way in the past. So this is a lot smoother. So anyhow, that's how I'm teeing it up for you, and that's what I wanted to talk to you about today. And when you started the quarter, like I said, when we spoke last time, that was your comment that things seem pretty much priced to perfection, and that's always kind of a warning sign or a concern sign, right, on what's going to happen next, because at some point in time, you and I have been in this business long enough to know that no matter what goes on, rationality eventually sets in for most companies and most performance, right? So and I think that's, from my personal perspective, that's kind of where we are right now. We're starting to see more rational thinking in the market, which translates into some significant price corrections, especially in the tech and AI sector, where the euphoria is starting to wear off, and you're starting to say, okay, is this really a company? Is this really all this growth momentum? Are they really going to play things out this way, right?
Yeah. It's a great way to look at it. First quarter earnings were nothing short of spectacular. Right? We had companies. We had about 87% of the companies reported beat estimates. We had the largest number of companies raise guidance that we've had in years. But it was interesting when you looked at how the stocks performed around the earnings reports with the spectacular numbers that came in. If you were in line with estimates or beat them by 5%, the stock was actually down marginally, right? So that starts to show you expectations, what's in print versus what's expected, or different things. We used to call it the whisper number, right? There was, where the analysts were in print. Hey, we're looking for $1 a share, but they're telling you on the side, like, we think it's really going to be $1.05. So that's kind of the ultimately it's reality minus expectations. So the reality has to be so much better than expectations to move the stock. It's getting harder. And we've seen that. We've seen rotations in the tech sector is a great example, where for a while it's just the hyperscaler. The hyperscalers are taking off. They're doing fantastic. And then they kind of pulled back. And then we had the microprocessor and software companies did well, and then they pulled back. And now it's all about memory chips, and they're starting to pull back. But what's interesting is it's a kind of like a rotation in the market rather than a full on sell off, which is what we typically get with like a big 15 or 20% correction. We're just having that within sectors, and it's just rotating, and the market's treading water. We had our 24th new high of the year on June the 2nd, and we're within a stone's throw of that right now. And the market's just been treading water. The second quarter earnings reporting season, which is just starting out, is going to be really, really important. We have to see some pretty spectacular numbers to keep moving the market up and hitting new highs. But we're optimistic it's going to be a good quarter. But it just gets tougher, as I said, as the companies beat estimates, the numbers come up, and so now the bar is set higher each time. And that's kind of where we are right now.
Okay. So I kind of feel that way too, that not that most of the gains have been made for the year. I don't believe that, but I think it's going to get tougher to finish the year. So mechanically, back to Clark Capital. You guys see this, and your research team and your analysts are phenomenal folks. You know me, from a compliance point of view, we don't get into specific companies and tactics like that, but strategically, we can talk about. Strategically, how have you guys approached this quarter in terms of allocation changes or sectors that are looking riskier than maybe they did 3 months ago?
Yeah, it's a great question. A lot of what we have done this year is risk management. And as the companies that we've invested in have appreciated, some of them quite dramatically, what we've been doing is paring that back to manage the position size, and which to us is controlling risk. If you don't prune your garden, it's going to be overgrown with weeds, right? So what we want to do is not have any one position become so large that it dominates all of the performance, particularly because, and specifically in the tech area, they can be pretty volatile in terms of the way the stock price moves. So what we've been doing is harvesting some of the gains that we've had in the portfolio to control those position sizes, which then is controlling the risk. A lot of that is in the technology sector. That's the area that's moved the most, and that's kind of what you would see if you were to look through our roster of sales. So what are we doing? We're redeploying it to things that are a little bit more attractively priced relative to the growth rates. That's what it comes down to is when you're buying a company, you're becoming a business owner. How much money does the company make? How fast are the earnings growing? And what am I willing to pay for it? Right? It's kind of the intersection of all of those dynamics. And with the move in technology, as we said, sort of being priced to perfection, we've scaled that back a little bit and redeployed it into other areas that have, might be more potential, like industrials, for example, are cheaper and have pretty reasonable growth rate. Even utilities have pretty reasonable earnings growth rate right now. A lot of it kind of tangentially related to AI and data warehouse. There's a tremendous demand on energy right now, so you're starting to see other areas benefit from it as well.
You know, it's funny you use the term risk management because I've been using that a lot lately in the last quarter. Because as you know, my roots are in the insurance business. That's where my family started. That's where our company started. And I like to say that one of the things I learned from that before we got into the financial planning business was we still apply risk management strategies to the wealth side of the business because it's equally as important. And when markets are going up and when you're not overly weighted tech, we don't look as fun or as sexy, but we look more consistent. It's times when we go through now the rotation correction, I'll call it that, of the tech sector, where all of a sudden these risk management strategies make a lot more sense. Because one of the things, the reason we work so well together is protecting the downside as best we can is just as important as trying to achieve the upside, right?
Harry Clark, our founder, has a great saying. He says, "We're in the stay rich business, not the get rich business."
Yeah.
Right? And to me, I would rather be the highest batting average baseball player than the one that hits the most home runs and also strikes out the most. Right? So it's about consistency. It's settling for less gain on the upside to make sure that you're then protecting on the downside more. And that's a trade-off we're willing to take all the time. We always consistently talk about risk-adjusted returns. That's what we're striving for.
So
Good risk-adjusted returns.
So give a little more context, Glenn, of what a risk-adjusted return definition is, so our listeners can better understand that.
Well, it's the amount of volatility that you're willing to accept to get the gains, right? So, a startup company, just hypothetically, a startup company could have tremendous potential on the upside, but it's got a lot of risk. It could be out of business. It may not be successful, right? So that return, while it may be very high, you need to think about the amount of risk that you took to get there. So to us, we would rather buy a more mature, established company that may not be growing as quickly, may not have as much upside potential, but they have some upside potential, but they're not going to go out of business, right? So it's kind of reining in the volatility, if you will. Think about San Diego weather versus New York weather, right?
Mm-hmm.
Might both average 72 a year, but the range in San Diego is a lot smaller than the range on the East Coast or anywhere else, right? So what we're trying to do is drive the portfolio more towards San Diego. We're not going to get that little volatility, but what we're trying to do is, curb the highs down and curb the lows up.
Right, sure. Mm-hmm. That's where it becomes an art, not a science. I mean, it's a science to a degree, but at the end of the day, it's still a judgment call.
Correct.
Right, and that's where the skill sets of your portfolio leadership team really come into play on that. So, and I want to balance this with another question: is in this market, what I want listeners to understand is where this is different. Is everything's ebbing and flowing, and it's changing, and it's not about what decision you made 3 months ago and sticking to it, because in our business we know that whatever the basis of a decision was could change tomorrow. So we have to be willing to change on that. So what I'm getting at is getting a balance between managing short-term objectives and long-term objectives and blending those together, right? So give a little insight on that.
So a good way to think about it, let's say we buy a company at $100 a share, and we think over the next few years it's worth $200 a share, right? As the earnings grow over the next 3 years. So that's kind of what the buy thesis might be. Well, everybody in the market gets excited about that company, and all of a sudden it's at $200 a share in 6 months. What are we? Or we could think, oh wow, look how smart we are. We hit our price target early. Let's just stay invested. That's not really the right thing to do from a risk control standpoint. If the stock has appreciated so rapidly and the fundamentals are relatively the same as when you bought it, the prudent thing to do would be to trim back that position, scale it back so that you don't have as much company specific risk in the portfolio. Market risk you can't eliminate, right? Market risk is there, but what you can do is minimize company specific risk. And so in that example, the stock went up far faster than we expected. What we're going to be doing at that point is trimming back that position and redeploying that into other areas where stocks haven't moved up as much.
Okay.
Does that make sense?
Makes perfect sense. Right. Back to risk management, right?
It's about risk management. Exactly.
Yeah. And I think the average investor, which we've talked about before, they tend to own when they buy stocks, and like they own other things, and they tend to be emotionally committed to them. And you guys aren't,
No.
And that's a key differential that you guys provide. And this is where having individual portfolios is really where the risk management comes from. Because, as you know, Glenn, we've seen all the time, we've seen it for decades. When people don't understand something, they focus on what they understand. And sometimes that's rates of return. They understand percentages, but they don't understand the process or the ride along the way of what it took to get there, right?
Right.
So, and look at performance for the Clark Capital Group overall for the quarter. And we'll get into that a little bit more about how the risk management strategies really paid off.
Right. Yeah, it was a good quarter across the board, right? We for the S&P 500 had best quarter in 6 years, right? So you got to go back to the end of 2020, post-COVID, as the stock market started to rally. Small caps are up over 20%, as an asset class. It was just really solid across the board. June was, not as great of a month, a little sort of treading water. That you really started to see the large cap growth companies, and tech in particular, were down in the month of June, where everything out the market started to move in onto other things, which to us is a very healthy sign. If it's just about large cap growth and just about technology, that's a pretty narrow leadership of the market, and that typically can't last that long. You can't have all of the money funneling into a handful of stocks. So looking at the Magnificent Seven companies, that they were down 9% in the month of June. Right? They, and these are all good companies, great cash flow. But they're priced a little bit, for perfection. And what we saw is some profit taking there and being deployed into perhaps a little less exciting businesses, but where companies are more attractively valued relative to what you get. So we saw a pretty solid rotation, and it's still going on. Again, that's why, while it may not feel good to realize a gain and then see the stock go up more, but that's actually the way you want to do, is keep from having too much of a concentration in any one company,
Right.
no matter how much you like it.
Right. Because for years, as we've talked about this in the past, being in small or mids or international was kind of a draw on a portfolio. It wasn't really healthy because of, like you said, the sector concentration we had for the stocks that were hot, which really propped up the S&P over time. But it was kind of a false narrative, because what really lied underneath wasn't as strong as it should have been. And now with the rotations to different sectors and having allocations beyond an index is where performance is really getting stronger.
It was interesting. If you look at kind of the style boxes, as we call them, and you can think of large cap, mid cap, small cap, growth, core, value. Through June, the large cap value was up about a little over 16%. Large cap growth was only up 5%. Right. And so we've seen a pretty significant shift in what's working in the market. Small cap is up. The Russell 2000 was up over 22% year to date. Right. So it's now not just large cap growth anymore. It's broadened out. Value companies are starting to do well. Mid and small are starting to do well, and international is doing well. To us, that's all good. That's all healthy to see that happen in the market.
Yeah, and to see the base of the market performing the way it is, I agree. I like to see that broader support, and that's where we've said this since we've known each other, and I've said it since we've gotten the business, that diversification matters. And for so many years, the diversification argument really wasn't holding water, right? And even though we still argued and advocated diversification, because in this quarter, again, back to mechanically, back in this quarter, diversification always works eventually. And when you find out it works, it's normally after the fact, right?
That's right. That's right. I mean, you think about the principle that as soon as you buy more than one thing in a portfolio, you've now conceded that your goal isn't to have the highest return, right? By a second thing, they can't both be up the most, right? One's going to have done better than the other. What you're doing specifically is now trying to manage your risk, right? So if you buy a third stock or third asset class, it's adding more diversification to the portfolio, and they go in cycles. And you're right. If everybody had a crystal ball, you'd always be in the one sector or the one style box that was the best. But the reality is you need to be prepared for whatever may work. I don't know that everybody got that rotation out of large cap growth right. But what's interesting is that if you look at the period of time where the large cap stocks did well, their earnings growth was far better than any other part of the market, right? So, if you're looking at kind of the PE multiples were higher, so you're paying 22 times earnings for the S&P 500, and small cap was 15, right? But there was no earnings growth there up until the last year or so, or a little more than a year. Now you've started to see small cap earnings go up, mid cap earnings go up, international earnings going up. So now all of a sudden they're a lot cheaper, and you have fairly comparable earnings growth. Now that's why they're starting to catch up in terms of price now. It makes sense.
Right, exactly. So that's been key. So what other internal strategies are you guys deploying right now because of these sector rotations?
I think our our overarching principles never change, right? We look for companies that have quality we call anti-fragility, right? This is the stability of their business models. Different companies can react, their business can react differently to changing economic environments. We want to find companies that are pretty consistent and pretty steady. They're not going to be broken by if suddenly the GDP pulls back a little bit, we have a weaker economy. So we want to find anti-fragile companies that have improving business momentum. And that's really important to us. If business is getting better, that's usually a pretty favorable condition for the stock prices going up. And then lastly, we want to get them at a good price. Right? We don't not necessarily bargain hunters that for the looking for the bottom. We want to make sure that the price that we're paying is fair or better relative to what the expectations that we have for that company. So a lot of that we just constantly are applying that lens to the market. As the market conditions are changing, different companies are coming in and out of our radar screen. Right? So that's going to drive what our decisions are in the portfolios.
Okay. And especially like this market where things are finally hitting what we used to know as effective diversification, which is panning out. But and that's the other reason I wanted to talk about this today, Glenn, if you're not ready for that, if your portfolio is not ready for that, there's a lot you missed. And I think that's the key point I want listeners to take away from this is active portfolio management really, really matters. And there's been years where the markets have all gone straight up and people were arguing that active portfolio management isn't worth the cost. Well, not everything stays up, as we know, and we've been down this road and we've lived in this world a long time, that right now when you have things like we spoke about, price near perfection, right? So there's not as much opportunity the way it looks. But if you're in a passive-based portfolio, there's not really much you can do. It just it exists and lives the way it lives.
Well, what's kind of interesting to me is if you think about a passive portfolio that's, let's say it's tracking the S&P 500. The S&P 500 has become incredibly concentrated. Right? The top 10 stocks are approaching 50% of the benchmark. They're over 40% of the benchmark. So the passive portfolios, in our opinion, in many instances are riskier than the actively managed portfolios because we're striving to have a more diversified portfolio than having half of the portfolio in 10 companies, right? So it's great the market's going up, that's wonderful, but you've got a lot of company specific risk in those passive investments. And I'm just not sure people aren't necessarily aware of that. Right? The benchmarks have become less diversified than they have been in the past, particularly S&P 500, for example.
Yeah, and that's our pure definition of the concentration risk. Got to take a break, but when we come back, Glenn, let's get into some of the macro stuff that we normally do. I got some questions I want to ask you, so on our way back, we'll get right into that, okay? Okay, this is Leo DePerli. This is the Gem Young Wealthcast. We'll be back after this break.
Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Hey there, this is Dan Rivers. Friends, if you're planning for a work-optional lifestyle or looking for financial insight or just want real conversations that help you make smarter decisions, we've got you covered. Listen to the Gem Young Wealthcast anywhere you get your podcasts, including Apple Podcasts, Spotify, and the iHeart app. And now you can watch the full video podcast on their YouTube channel, Gem Young Wealthcast with Leo. New episodes every week featuring professionals, local leaders, and conversations that matter.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Diprilli.
Welcome back to the Gem Young Wealthcast. This is Leo Diprilli. If you're just joining the program today, I have with me Glenn Dorsey. He's the Senior Vice President and Head of Client Portfolio Management at Clark Capital Management Group. And this is part of our quarterly analyst roundtable. So the first part of the show today, we got more into the mechanics of what Clark's doing in this market environment, strategically how they're approaching sectors priced to perfection, maybe going through sector rotation or things, some of the things we talked about. And towards the end of the segment, Glenn brought up an interesting point about concentration risk. You know, we talked a lot in that segment about managing the risk. It's not just managing the upside, it's managing the downside. You hear me say that all the time, but I wanted you to hear today how that actually happens and some of the decision processes that go with it. So we kind of got under the hood in the first segment of the show so that you could see how all of that was going on and what was happening and get Glenn's insight. When we were closing this segment, what he said something to me that really surprised me, and back to the risk management strategy with the S&P 500, with the top 10 stocks commanding almost 50% of its value, we call that concentration risk, and that's becoming concerning. So even though you think you're diversified, and you are technically into 500 different companies, but the weight of the top 10 stocks is going to have significant impact on what your performance is going forward. Now, this has been going on for the last 8 to 10 years where those stocks have performed well, so you haven't really cared maybe that you have this concentration risk. But if you have a tech-heavy portfolio, whether it be software stocks or hyperscalers or memory chip makers, you're feeling this more than you did before. And you're feeling returns, more negative returns than maybe you thought. So that was, anyhow, I just wanted to bring that back up, Glenn, because I think that's a super important point, because so many people have their money in 401ks, and many of them default to just taking the S&P 500 index portfolio. So I think there's greater risk than maybe they're aware of. So that was an excellent point. I want to appreciate you that you brought that up.
Yeah, my pleasure.
Okay.
It's our grandparents were pretty smart. Don't put all your eggs in one basket.
That's right. Yeah.
And
I say that's the Depression era teaching. And that's where I say that saying came from, because they saw so many people lose things. And I think that was one of the great lessons out of it. On a side note, I think that's part of one of the things I've talked about in prior shows, Glenn, is where the flaw that I call it Depression era thinking that has made people wealthy and more stable. But the only challenge to that is I talk a lot about good debt and bad debt on this show. And the Depression era generation also raised people to say, don't owe anybody any money, because they saw people lose things. So it came, the advice came from love, and it came from real world experiences, but it's a different world today. So I like to say that people's view on debt is 3 generations and needs to change. We need to rethink how we approach debt. So anyhow, that's a side note. But let's get macro here. Okay. So we talked about nuts and bolts in the first session. This time, let's talk a little bit about corporate think in terms of the new Fed chair. We talked last time that he's in an impossible position, and I think he remains in an impossible position. So, and I saw this past week, Glenn, that there's 50%, the traders, how they evaluate whether the Fed's going to be increasing interest rates, there's a 50-50 probability that interest rates may go up, right? So
Right.
What are your thoughts on that?
Well, so let's go back to our new Fed chair, Kevin Warsh, right? So,
Okay.
during the whole appointment process and before he was confirmed, everybody said, "Oh, he's just gonna come in and lower rates. He's gonna be, the president's puppet." And they're going to have a lot of dissension amongst the 12 voting members of the Fed. So what happened at the first meeting? They had a unanimous vote, 12-0, first unanimous vote they've had in a while, not to raise rates, not to lower rates either, right? And he very explicitly said multiple times, we are going to get back to our inflation target. It's been allowed to be too high for too long. So all of a sudden, the person that was supposed to be this dove who's going to cut rates came out more aggressively talking about inflation than anybody has in a long time. So everybody got that completely wrong. And actually, if you look objectively at what his history was, you shouldn't have been surprised. He's never been considered in what we've seen in the past, and he was a Fed governor before, so there was a track record. He was never really a dove. He seems pretty reasonable. The next thing that he did, he said, "I'm going to have these 5 different task force," and he appointed filled out those 5 areas right now, and unanimously, he's getting applause for that. Who his selections were. Pretty high level academics, high level business people, and is there data integrity? Right? What's the potential for productivity gains with AI? What about the inflation data? You can't make good decisions if you don't have good data. So the way he's approaching everything is very systematic. I think he's earned a lot of respect pretty quickly. So that's encouraging. In terms of the market is pricing at this point, it's almost a coin toss for the July meeting if they raise rates, and a better than 50% chance that they raise by the September meeting. Which, there's this feeling about the Fed hiking is the market's going to crash, right? That's kind of what everybody's implying. But the reality is that yes, the stocks will do better if the Fed is lowering rates slowly. Right? That tells you things are okay. They're just adding a little bit of gas. They put a little bit more gas on the pressure on the gas pedal. But after the first rate hike, if it's a slow cycle, which everybody pretty much expects that they're not going to raise rates very aggressively, the S&P 500 a year later is up 10.5%. That's not a bad return. It's when the Fed is raising rates aggressively that's problematic, like in 2022. Right? That's a bad environment. But a slow adjustment to the Fed funds rate is not going to be, it hasn't historically been disruptive to the market. And we don't see any reason why it will. If you think about, we've had 6 quarters of double-digit earnings growth. The next 7 are expected, or next 6 are expected to be also double-digit earnings increases. So from the business side of the equation, the earnings side of the equation, things are pretty good. As long as the Fed doesn't start blowing a 70-mile-an-hour headwind on that, the market should be fine. So we're not overly concerned about if they raise rates a quarter of a point. And I think it's July 29th is the next meeting, or whether they do it in September, or whether they do it later in the year. The market should be okay because the fundamentals are solid. If you think about, they have a dual mandate, right? It is full employment and price stability. Okay, so if you think about full employment, look at the unemployment rate has been drifting down, right? So we're good on the employment side, and inflation has been drifting up, right? Not surprising given what's going on in Iran. So if you look at where the pressure is in terms of them hitting each of their 2 goals, the pressure right now is on the inflation side. So I think it's fair that they have a hiking bias at this point.
So I'll speak to the obvious for a minute, right? The first segment, we talked about how spectacular earnings were in Q1, right? And we spoke in the first segment about how many companies are participating and doing well, right? That naturally lends itself to a rise in inflation because that means you have a robust economy, right? So as much as we want to blame just the war with Iran, because it's increasing the price of fuel, which increases everything that you buy. So, and even though there's the argument and debate we've had ad nauseum about the word transitory when it comes to inflation, right? Even if you take that out, inflation's still running too hot because the economy is doing really well. So I look at it and say, if the interest rates go up a little bit, I know politically it's not great. I know it's not great for the deficit, but at the same time, when interest rates go up, it takes a long time before that gets into the cost of borrowing. It's not an immediate effect that day. So that's something for the listeners to understand about that. But, knowing that things are running strong, and if they're just trying to continue, I use the term all the time of just kind of tune the dials for those old enough again to remember what that really means, right? I don't think it's a bad thing.
Yeah, there's a lot to unpack there. So if you X out energy prices, which hopefully that we get things resolved there, and we'll see energy prices start to go back down again. We were in an oversupply situation of oil prior to this, so energy prices had been drifting down. It was a good tailwind for the economy. If you take out energy prices out of the equation right now, the areas the data warehouse build out is actually helping fuel inflation right now, right? So there's not enough chips, there's not enough memory, there's not enough construction workers to build them, there's not enough construction equipment, there's not enough power, there's not enough water. Like there's a lot of different things that go into this massive $700 billion commitment this year that's going to be spent, and probably $1 trillion within a couple of years. That's fueling a lot of demand, right? So I think inflation is ticking up a little bit. Ultimately, it goes the other way. It's going to be a productivity enhancer, right? All of this build out. I don't know if you've used AI, you can really see how much time it can save you. Right? I'm not going to jump on up and down and say it's the greatest thing, because it makes mistakes, but some things that would take hours can now take minutes. Right? So that's ultimately a productivity gain, right? So that's deflationary, disinflationary. So the next aspect of it is when we talk about the Fed raising rates, right? They control the federal funds rate. They control the discount rate. The federal funds rate is overnight lending between banks, right? So it's very, very short term in nature. In fact, as the Fed was lowering rates coming off of the high levels that we had in 2022, as they lowered rates last year and the year before, longer term rates actually went up a little bit. Right? So what you very well may find, and we think this is likely, is if the Fed starts to raise short term rates, it would not be uncommon to see longer term interest rates come down. The reason is, if you think about the Fed funds rate as a gas pedal or a brake pedal, right? If they're raising it, they're tapping on the brakes. That's going to slow down the economy, not dramatically. It'll slow it, but it also will lessen the possibility of inflation down the road, which is why often when the Fed's raising short-term rates, you'll see long-term rates actually go down.
So back to Kevin Warsh for a minute. When he was a Fed governor, he tended to be more hawkish than a dove.
Yeah, I think he has. He does not like excessive central bank intervention, right? So when the Fed was out doing a quantitative easing, buying treasuries aggressively, he was in favor of it to a point, and then thought they were doing too much. And objectively, I wouldn't disagree with that. I think he is very data dependent. I don't think he necessarily has a preconceived notion whether he's lowering rates or raising rates. I think he sees what's coming in terms of what's happening in their dual mandate, and then is going to make adjustments accordingly. But he wants the Fed to be less visible than it is today. If when I started in the business, and when you started the business, there was no Fed press conference after they had a meeting. They didn't tell you what they did. It was a mystery. Alan Greenspan, as famous as he was, didn't hold a press conference and say, well, we've done this and we expect we're going to do this more or less. That didn't come around until Bernanke came in, where they started to talk about what they're going to do. And all of a sudden, the Fed became a bigger focal point of the markets than it ever was before. Right? And I think Warsh is tending to think that the Fed should be seen less and do things more behind the scenes. And I think that's probably healthy for the markets.
I would agree. And I think for two reasons. Number one, back to Alan Greenspan for a minute. When he would speak, Glenn, when he was done, I'd say, does anybody have any idea what he said?
Great vocabulary.
Yeah, didn't he?
Yeah, fantastic.
Right. And he never, ever addressed an issue head on. Yeah. So, and I think Kevin Warsh is what he's trying to do by quieting the Fed down, is not just make it, to your point, such a focal point of the market, but I think it's become a political football because they're out there too much. And I think by pulling that back, to your point, it'll be less data dependent on that. So all of that stuff being said so far, and everything with the risk management strategies, what does this next quarter, the rest of the year, where are you guys focused and where do you see risks and opportunities?
So from a bigger picture, we actually raised our target for the S&P 500. We had started out the year with a 7,700 target, which that's a pretty big increase. Our feeling was that we would probably a lot of the gains would be front end loaded, choppier period in the middle of the year, followed by a strong finish. We raised our 7,700 target to 8,100,
Wow, that's
based
significant.
based entirely on the earnings that have been booked already and should be booked by the end of the year. So again, if you think about the price of the market is really the earnings times some multiple that you put on it. All of the increase came from the earnings side of the equation. We actually lowered our PE target a little bit, and we still get to 8,100. And in fact, could make a case that it could be even stronger than that. We tend to like to be, if we're going to miss, we like to miss on the low side with our target. So now, lest I sound like everything is rosy and there's nothing to worry about, it's a midterm election year. Historically, the market doesn't like midterm election years. It's the worst returning year of the 4-year presidential cycle, and it's specifically concentrated in kind of the time period we're in right now, from now till typically October. Right? The market sideways down, and then ends the year strong before the results are even in. So it's not really about who's going to have power or not, whether it's red or blue or any of the purple or any other combination that is out there. It's a lot of, I think, a lot of the anxiety around the unknown. But as the market always does, it anticipates what's going to happen and moves up, starts to move up before the results are out. So wouldn't be surprising to see a little bit of choppiness in here. But from a fundamental standpoint, if stock prices are going sideways or even down somewhat and earnings continue to grow, with second quarter earnings expected to be up 26% versus a year ago, that to us is just more opportunity to add great names to the portfolio at more attractive prices. So everything boils down to earnings, which are the economy certainly drives earnings. And from a big picture standpoint, if you look at the economy, it's roughly 2/3 to 70% is the consumer, is for the U.S. economy. The balance is business investment and government spending, right? The consumer's doing okay, despite everything that you're hearing, and the K-shaped recovery and consumer sentiment. This is the one I love. The University of Michigan puts out a monthly survey of how consumers feel, right? And this has been around since 1952. Now, if you're a student of history, 1952 wasn't a great time globally. We were in the midst of the Korean War, right? And China, our relationship with China was not good, and the world was sort of on the brink of that potentially being horrible. And then we had issues. We had the Vietnam War, we had Watergate, we had oil embargo. We had a lot of bad things have happened in this time period. Yet somehow or another, 2 months ago, the University of Michigan survey was the lowest it's ever been, which is astonishing to me. So, and anybody that's our age or older would say, really, this is the worst time that this country has ever had? I don't think so. And then you look at what the consumers actually doing, not what they're saying, but what they're doing. What are they doing? They're spending. Retail sales have continued to go up, and it's not just driven by higher gas prices. Hotels are doing well. Airlines are doing well. I fly a lot. I can't remember the last time I was on a flight that wasn't full. Right? And it's objectively, it's not just the top 1% of the people by income are the ones that are flying commercial, right? First of all, they're on private jets, probably, right?
Right.
So it's a pretty broad group of folks on the plane. So people, I think with unemployment continuing to be fairly low, which means employment is fairly strong, people are making money and they're spending it. At the same time, the baby boomers, us, we have $90 trillion of assets that we're spending.
Yeah.
Right. A lot of the baby boomers are moving into that distribution phase of life, and so you say, oh well, income levels are going down, but somehow or another spending levels are going up. Well, you know why? Because a baby boomer retired and they've got a ton of money saved because they did a good job of putting money away and investing, and they're still living their lives, right? So it's demographically, we should expect this. Income levels are going to go down relative to spending because there's a lot of people that aren't going to be taking a paycheck that are going to be traveling, right? They're going to be booking river cruises and flying to Europe and doing all this stuff, spending some of that hard-earned money that they saved. So there's a lot of fuel out there for the economy. So consumer, pretty good shape. Business investment, which is a good chunk of economy. Well, we talked about the data warehouse build out. That's going to be gigantic. And the government is the last part of it. Well, I think we can all agree the government is going to continue to spend money.
Right.
So from our perspective, longer term, the economy looks to be in pretty good shape. They need to get the inflation back on track, which they will. And energy prices tend to take care of themselves. Right? The best cure for high energy prices is high energy prices. People stop driving as much.
Right. Sure.
Right. So it's good old supply and demand still works.
Awesome. Well, Glenn, thank you. This was a great show, great finish. A great way to wrap it all up. I appreciate you as always. Glenn Dorsey, Senior Vice President, Clark Capital Management Group. Talk to you soon, Glenn.
Thank you, Leo.
You bet. This is Leo DePrilli. This is the Gem Young Wealthcast. I'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare supplement insurance plans. This is an advertisement for insurance.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprilli.
Welcome back to the Gem Young Wealthcast. This is Leo Daprilli. I want to thank Glenn today. It was a great show today. There's a lot of key takeaways that I want you to think about. The one that's probably the most substantial that we talked about today was risk management to your portfolio. The sector rotation out of large cap growth was a key takeaway from today, and how large cap value has significantly outperformed large cap growth. So these are some key points. Another key point was that the top 10 holdings in the S&P 500 are now comprising 50% of the performance of the S&P 500. So that's significant concentration risk. We've talked about it before. I remember it just as little as maybe 3 years ago that was 29%. So when you have that much concentration risk and you're thinking you're diversified, which technically you're diversified, but when you're weighted that heavy, that's cause for concern. So today's message today was risk management in the challenging times. But the way Glenn finished his conversation with me, when he talked about that things are robust and the baby boomers are sitting on $92 trillion. So when we look at consumer spending, sometimes we get focused on ourselves or focused on our work or people that work, and we don't look at how well the market's performed over the last 5 or 6 years and how much wealth has been created along the way. So there's a lot of unearned income being spent to support the economy, and it's happening, even though consumer sentiment is at an all-time low since 1952, another fact Glenn pointed out. So there's a lot of data out there, and this is where it gets challenging for you, and that's why we do these shows, to try to help you sift you through the data and help you find the data that really matters and the data that's effective to helping you make decisions. So we're a podcast and a video podcast. Check us out anywhere you get your downloads. This is Leo Daprilli. This is the Gem Young Wealthcast. Until next time.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
Hey there, this is Dan Rivers. Friends, if you're planning for a work-optional lifestyle or looking for financial insight or just want real conversations that help you make smarter decisions, we've got you covered. Listen to the Gem Young Wealthcast anywhere you get your podcasts, including Apple Podcasts, Spotify, and the iHeart app. And now you can watch the full video podcast on their YouTube channel, Gem Young Wealthcast with Leo. New episodes every week featuring professionals, local leaders, and conversations that matter.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprilli.